There is a piece of information that has been circulating for less than 24 hours and that has not received anywhere near the attention it deserves. As of yesterday, the 15th of April 2026, the United States Navy has declared its blockade of Iranian ports fully implemented, not partially, not operationally, completely. That means the country with the world's third largest proven oil reserves, a country whose seaborne trade represents 90% of its $109.7 billion annual economy, has been cut off from the global trading system entirely. Take a moment to absorb what that actually means. Not for Iran, for you. For the price you paid at the gas station this week, because the blockade that Washington framed as a military operation against a nuclear adversary is already functioning as something else. It is functioning as a tax imposed without a vote, without a congressional authorization, without the consent of the people paying it. And the people paying it are not in Tehran. They are in every American city and suburb, at every pump, in every grocery aisle, and most of them do not yet understand why. Here is what is actually at stake across every dimension. The US-Iran war, now in its 46th day, has pushed Brent crude oil to $102 a barrel. That is a 40% increase since the conflict began. WTI, the American benchmark, is trading at $104 per barrel. That is a 50% increase from pre-war levels. The national average price of unleaded gasoline in the United States this week, $4.12 per gallon. That is $1.20 higher than it was before the first shot was fired. Now translate that into the American economy. The United States consumes approximately 370 million gallons of gasoline per day, $1.20 per gallon, across 370 million gallons every single day. That is approximately $162 billion extracted from American consumer spending in a single year. The International Monetary Fund revised its global growth forecast this week, downward to 3.1% for 2026, down from 3.3% in January. It cited the Hormuz blockade as the primary driver and warned explicitly of an adverse scenario in which oil stays near $100 per barrel and global growth contracts to below 2%, the technical threshold for a global recession. The International Energy Agency has now warned of what it calls a historic oil supply shock. And the ceasefire that is currently preventing full military escalation expires in 5 days on April 21st. Today, we are going to break this down the way it deserves to be broken down, with the actual numbers, the precise mechanisms, the real consequences across every dimension. If you want to stay ahead of this situation as it develops specifically, whether the ceasefire survives April 21st, whether oil crosses $110, whether the US economy tips into stagflation, and what the next round of talks in Islamabad actually resolves. Subscribe to Nexus Report right now and activate all notifications. We are tracking every significant development in this story the moment it happens. The naval movements, the negotiating positions, the oil market signals, and the political calculations that no mainstream outlet is naming plainly. The clock is running. 5 days. Hit subscribe. Let's go through this completely. The first dimension is financial attrition. The blockade is not a military siege in any traditional historical sense. It is a financial pressure mechanism, and to understand it fully, you need to understand the specific cost asymmetry between what it is costing Iran and what it is costing the United States to maintain. According to U.S. Central Command's own estimates, Iran is losing approximately $435 million per day from the blockade. That figure encompasses lost oil export revenue, halted seaborne imports, frozen trade contracts, and the cascading disruption to an economy that flows almost exclusively through the Strait of Hormuz. For context, Iran's entire annual GDP is approximately $366 billion, roughly $1 billion per day of economic output. The blockade is extracting, in direct measurable damage, nearly half of Iran's daily economic production. The United States, by contrast, is deploying more than 10,000 troops, over a dozen Navy ships, and a continuous rotation of fighter jet coverage across the Gulf of Oman and the Arabian Sea. Military analysts estimate the operational cost of sustaining this deployment at approximately $80 to $100 million per day. The ratio. For every dollar the US spends to maintain the blockade, Iran loses approximately $5. In isolation, the mathematics of this attrition are not competitive. Iran bleeds at 5 times the rate of its adversary. At that ratio, the financial logic of the blockade is straightforward. But this is only part of the picture. The second dimension is the oil price paradox. Here is where the financial attrition calculation becomes structurally dangerous and where Washington's strategic logic begins to contradict itself in ways that no official will name publicly. The Strait of Hormuz does not only carry Iranian oil. Approximately 20% of global oil supply transits through this waterway. Saudi crude, Emirati crude, Kuwaiti, and Qatari exports. When the United States established its naval blockade, it did not only block Tehran's oil, it restricted the world's most critical petroleum choke point. The result was immediate and arithmetically predictable: Brent crude at $102 per barrel. Now apply that premium to the US domestic economy directly. America consumes 20 million barrels of oil per day. Every $10 increase in the price of oil represents approximately $73 billion in annual economic drag. The current premium, roughly $30 above pre-war levels, represents a sustained annual drag of over $200 billion on the US economy. That $200 billion is not caused by Iranian military action, it is caused by a US military decision. Washington imposed the blockade. Washington is absorbing the oil price consequence. And the people absorbing that consequence at $4.12 per gallon did not vote on whether the blockade was worth that cost. The IEA has now called this a historic oil supply shock. Goldman Sachs's internal modeling has flagged the threshold. If Brent sustains above $110 per barrel, their recession probability model activates for the second half of 2026. If it crosses $150, which their severe scenario model projects. If the ceasefire collapses entirely and Iranian proxy forces begin targeting Saudi infrastructure, the IMF's own numbers project global. Inflation rising to 5.8% and global growth falling to the technical recession threshold of below 2%. But here lies the contradiction at the center of this entire strategy. The Trump administration ran on 2 economic pillars: energy dominance, keeping oil cheap, and American industry competitive, and protecting American consumers from foreign economic aggression. The blockade is producing the exact opposite outcome on both dimensions simultaneously. It has made oil expensive, and it is transferring wealth at scale and at speed from American consumers to energy producers. That structural irony is not accidental, and it is operating on a clock that is measurable in days. The third and deepest dimension is the negotiation trap. On April 11th and 12th, Vice President J.D. Vance led a 21-hour negotiating session in Islamabad, Pakistan. 21 hours. The talks failed. The specific point of failure: nuclear enrichment timelines. The United States proposed a 20-year suspension of Iranian uranium enrichment. Iran countered with a 5-year suspension. The US rejected it. The gap, 15 years, could not be bridged in 21 hours of continuous negotiation. The ceasefire currently preventing this conflict from full military escalation expires on April 21st, 5 days from today. Here is the trap in its precise structural form. If the ceasefire expires without extension, Iran does not need to engage the US Navy in a direct confrontation to escalate. It has multiple asymmetric options that operate outside the blockade perimeter entirely. Iranian-aligned Houthi forces in Yemen can resume targeting Red Sea shipping, which they previously demonstrated the capacity to do in 2024 and 2025. Iraqi Shia militias can begin targeting U.S. logistics infrastructure in the region. Iranian missile systems can target Gulf tanker routes beyond the naval cordon. Proxy escalation, not direct confrontation, is the Iranian doctrine. Any one of these escalation paths pushes Brent crude from $102 to $120 or beyond. Goldman Sachs has modeled this. Beyond $120 sustained for 60 days, the U.S. consumer recession probability exceeds 50%. So here is the negotiation trap in full. The United States cannot release the blockade without appearing to capitulate to Iranian nuclear ambitions, a capitulation that would be politically fatal for this administration domestically and geopolitically in terms of its credibility with Gulf allies, Israeli security guarantees, and European partners watching how Washington manages deterrence. But the United States cannot maintain the blockade indefinitely without $100 plus oil. And $100 plus oil is extracting over $200 billion per year from the American economy, creating the precise stagflation conditions that historically terminate American presidencies. Iran understands this calculation with precision. It does not need to win militarily, it needs to wait. Their negotiating doctrine, validated across 45 years, operates on a single, verified premise. The United States runs out of domestic political tolerance before Iran runs out of strategic patience. What is actually driving the stalemate in these negotiations is not what the mainstream coverage is naming. The coverage frames this as a technical dispute over enrichment timelines, 20 years versus 5 years, a manageable gap between two positions that could theoretically be bridged through negotiation. That framing is wrong. The surface disagreement about enrichment timelines is not the actual driver of the impasse. The actual structural driver is a concept that military and financial strategists call tolerance asymmetry. The question in any sustained confrontation is never which actor is stronger. The question is which actor can absorb more pain for longer before domestic political constraints force capitulation. In Iran's case, the tolerance calculation is unusual by any Western democratic standard. The Iranian population has endured 45 years of international sanctions, 3 separate currency crises, sustained inflation above 50%, repeated cycles of isolation, economic contraction, and political suppression. Its government does not face democratic accountability for that sustained pain. The Revolutionary Guard's institutional interests are not threatened by consumer-level economic suffering. They are, in certain structural ways, reinforced by it, because the narrative of American aggression is the regime's primary domestic legitimacy claim. In the United States' case, the tolerance calculation is acutely constrained. American democracy operates on a 2-year electoral cycle with continuous polling feedback. Gas prices at $4 per gallon generate congressional complaints within weeks. At $4.50, they generate measurable approval rating movement. At $5, they generate primary challenges and legislative pressure. Here is the specific data point that Washington appears not to have modeled adequately in its pre-blockade planning. The last time U.S. gas prices averaged above $4 per gallon for a sustained period, 2022, President Biden's approval rating declined 11 points over 6 months. The correlation between sustained elevated fuel costs and presidential approval ratings is one of the most statistically robust relationships in modern American political science. Trump's current approval ratings, which were strong entering this conflict, are now under visible pressure. The political arithmetic of $4.12 per gallon is not theoretical. It is operating right now in exactly the congressional districts and swing state demographics that delivered the 2024 electoral margin. Iran's strategic doctrine is aware of this. The Islamic Republic has studied American political psychology intensively for 45 years. Their current negotiating posture, offering 5 years, knowing the US needs 20, refusing to close the gap, is not negotiating incompetence. It is deliberate timeline management. A calibrated refusal. They are not at the table to reach an agreement. They are at the table to run out the calendar. Every week that passes without a deal is a week in which $4.12 per gallon is further eroding the domestic political foundation of the administration ordering the blockade. This is the mechanism that explains everything the mainstream coverage attributes to miscommunication, stubbornness, or ideological rigidity. It is none of those things. It is a rational calculation by an actor that has correctly identified the binding constraint on American strategic patience and is managing the negotiation to exploit it. The cost asymmetry is real, but it runs in both directions simultaneously. Iran bleeds dollars. America bleeds political tolerance. And the rate at which America bleeds political tolerance is not linear. It is accelerating. Let us examine with genuine analytical precision what happens across the 3 realistic scenarios over the next 90 days. Scenario 1. The most likely path carries a probability of approximately 60%. The ceasefire is extended past April 21st. Neither side is prepared for the consequences of full escalation, and both sides have domestic incentives to create the appearance of continued negotiation. A second round of talks is convened likely in a third-party venue, most probably Oman, which has served as the quiet channel for US-Iran back-channel communication in previous administrations. The gap on nuclear enrichment timelines is not bridged, but both sides agree to a partial face-saving framework. Iran accepts a rolling commitment to limit enrichment above 20% purity for a period of 10 to 12 years. The US accepts a partial modification of the blockade lifting restrictions on non-oil seaborne goods while maintaining naval presence at the Strait of Hormuz. Oil retreats to the $88 to $95 range. US gas prices decline by 40 to 60 cents per gallon over approximately 30 days following the announcement. This is the outcome both sides can politically survive. Iran's nuclear program is constrained but not dismantled. The US lifts partial pressure and claims strategic victory. The underlying structural standoff is not resolved, it is deferred. Watch for this signal, a statement from the Omani Foreign Ministry acknowledging consultations with both parties. Muscat does not announce its mediation in advance. The signal is a quiet acknowledgement, not a press conference. Scenario 2. The escalation path carries a probability of approximately 25%. The ceasefire expires April 21st without extension. Iran does not engage the US Navy directly. Instead, it activates its proxy architecture. Houthi drone and missile launches resume against Red Sea commercial shipping. Iraqi Shia militia groups begin targeting US logistics infrastructure. Iranian-backed forces in Lebanon demonstrate capability near the northern Israeli border. Oil moves to $115 to $125 per barrel within 2 weeks. The global economy absorbs a shock comparable in structural terms to the 1973 OPEC embargo. Goldman Sachs's recession model activates. The IMF's severe scenario, global inflation to 5.8%, global growth at the technical recession threshold, becomes the operating baseline rather than the downside case. The United States faces a binary strategic choice: massively escalate, which means direct strikes on Iranian territory and a ground campaign requiring congressional authorization that is not currently assembled, or negotiate from a position of visible weakness as oil approaches $120 and American consumer anger reaches political crisis levels. Watch for this signal. Houthi drone activity resuming in the Red Sea. That is the specific tripwire. Houthi escalation against commercial shipping is Iran's preferred first-step proxy option because it provides deniability and maximum economic impact at minimum direct risk. Scenario 3. The surprise de-escalation carries a probability of approximately 15%. A backroom channel, most likely the Qatar or Switzerland communication line, produces a sudden agreement before April 21st. Iran accepts a 15-year suspension of enrichment above 5% purity in exchange for a full blockade lift and structured sanctions relief. Trump announces it as a historic strategic victory. Iranian leadership describes it publicly as a tactical framework, not a surrender of nuclear rights. Oil returns to $78 to $85 per barrel within 30 days of the announcement. The U.S. consumer receives an effective $1 per gallon relief. Trump's approval ratings recover. This scenario requires Iran's Revolutionary Guard to accept an enrichment timeline significantly longer than its current public position. That is an internal Iranian political challenge that Tehran has not visibly resolved. Watch for this signal. An Iranian Foreign Ministry statement using the word framework rather than agreement. This specific linguistic distinction signals they are describing a mechanism, a process, not a commitment. That is what a face-saving deal looks like from the Iranian side before it is formally announced. What you are watching in the Strait of Hormuz is not a military operation. It is a price. A price paid at every gas station, factored into every grocery delivery, embedded in every inflation figure that central banks are trying to manage without triggering the recession they are trying to prevent. The strategic logic of the blockade is coherent. Iran is losing $435 million per day. That attrition is mathematically unsustainable indefinitely. But the arithmetic of $4.12 gasoline is not indefinitely sustainable in a democracy either, not in an electoral cycle, not when the people paying that price also vote. Watch the Omani channel. Watch the ceasefire expiration on April 21st. Watch the Goldman Sachs $110 threshold. It is the number the White House is tracking, even when no official will say so publicly. History is instructive on how confrontations between a democratic superpower and a sanctions-hardened adversary resolve. They do not resolve through military victory. They resolve through the question of who reaches the limit of domestic tolerance first. That question has never, across 45 years of U.S.-Iranian confrontation, been answered in Washington's favor. All sources are available in the description. Verify every figure for yourself. History does not repeat, but it rhymes, and those who cannot hear the rhyme are always surprised by what comes next.